Hello and welcome. Moss Adams is pleased that you've joined us for today's session, Prepare Your Life Sciences Company for an IPO. Before we begin, I'm going to play our housekeeping video.
Welcome, and thank you for viewing our webcast series. Before we begin, please keep the following in mind. You can customize how you view our presentation and interact with the presenter. For better viewing, close all other applications and turn up your speaker volume. You can adjust window size and placement or enter full screen mode using the controls at the top right of the window or dragging the bottom right-hand corner to resize. At the bottom of your screen, you'll see a series of icons that relate to a different aspect of our session. You can download a PDF of today's slides from the Slide Deck and Handouts widget. You can ask questions by typing in the Q&A window and clicking Submit. We'll do our best to answer all questions or follow up via email. If you experience technical difficulty, refresh your browser by hitting the F5 key. This presentation is not legal, investment, or accounting advice. We encourage you to seek the counsel of a professional service provider to apply this content to your specific circumstances.
All right, and we have a fantastic group of panelists with us today. And to kick off their introductions, I will hand it over to Sarah Ratra, Assurance Partner from our Life Sciences National Practice here at Moss Adams. Sarah?
Thank you, Amy. Good morning, everyone. I'm Sarah Ratra. I'm an audit partner with Moss Adams in our tech and life science practice. So I focus on a mix of public and private companies within the life science space. I've done several IPOs over the last number of years within the life science industry. Just in general, Moss Adams offers a range of services that span accounting, tax, consulting, and wealth management. I'll pass it over to Steve, who is also at Moss Adams.
Great, thank you, Sarah. So I'm Steve Feinberg. I'm my sixth year as a partner here at Moss Adams. Been with Moss almost 18 years. I work primarily in life sciences, and I do internal controls, SOX, and IT governance, IPO readiness. I'm looking forward to sharing my thoughts here. Karen?
Thanks, Steve. Hi, I'm Karen Deshane. I'm a partner at Wilson Sonsini. I have a general corporate and securities practice, and I represent exclusively life sciences companies, similar to Sarah, both private and public, and have done many IPOs for life sciences companies in the past decade plus.
Great, and my name is Greg Curhan. I'm a partner with FLG Partners. We're a consultancy of CFOs. We provide outsourced, permanent, part-time, interim CFO services to our clients. Personally, I focus on the life sciences area. My background includes 30 years as an investment banker for San Francisco-based investment banks. I've been a CFO for the last decade. I currently have 2 life science clients, both of whom are private. Previously, I took a company public in 2021 in the biotech space.
Great, thank you all. So we're here talking about IPOs, assuming that that's the plan for your company. As we can see, 2023 ended up being close in both sort of deal value and M&A volume to pre-pandemic levels. And 2024 may be similar. Global IPO market showing signs of resilience after a period when the IPO market was firmly shut for most companies. I'm going to pass it to Greg. Greg, what are your thoughts on the market outlook for IPOs, specifically in the life science space?
Sure. I want to caveat by saying if I was any good at prognosticating, I'd probably be on my private island and not this webcast right now. But having spent a lot of time in the IPO market, I probably took hundreds public as an investment banker and a number as CFO. I would say that in the life science sector, the market is always very cyclical. There's a lot of factors that come into play, but to me, the 2 that stand out are interest rates, because the lower the interest rates are, the more investors are willing to discount into the future. And a lot of life science companies have a long road to get through clinical trials to get their products to market. So they're often investing in companies that won't have revenues for a significant period of time. And then secondly, the attractiveness of the supply of companies to go public. And the last bull market in 18 to 21 happened during both a falling and a low interest rate environment and a lot of buzz in the healthcare area fueled by COVID. The world became very aware of how life science companies could respond to something as challenging as a pandemic and how quickly and how effectively. So the result was sort of record-setting levels of IPOs, 96 life science in 2021, 83 in 2020. So then the bear market started in 22, driven by the same two factors, in my opinion: rising interest rates and the fact that there was no supply left anymore of good life science companies who hadn't already gone public. 2024 feels like a bottom's being made. Interest rates feel like they're not going up anymore. Maybe they'll go down even this year. And you're seeing companies that have moved through stages of clinical trials over the last couple of years while the IPO market has been closed. You've also seen big pharma M&A heating up in the fourth quarter, and right before the JP Morgan conference this year, a number of deals were announced. So my feeling is later stage private companies are going to be able to access the IPO market at reasonable valuations going into 2024 and beyond. And if we get a little momentum, maybe we're back into the cyclical upswing.
Great, thank you. So sort of planning your company's IPO can be a catalyst for many positive changes throughout a business. And being prepared for this sort of will definitely help down the road. And so this preparedness process, which can take 6, 12, 18, 24 months even, sometimes helps pinpoint improvement areas that require upgrades for your business to actually function as a public company. I've seen companies often underestimate the requirements and level of effort associated with completing an IPO. And so there's a lot of planning that can be done way before even that thinking about an IPO process. Greg, what are the steps that you would have seen or would take sort of building an internal support system at one of your companies?
Sure. So the biggest change in my mind, going from a private company to a public company, is that a private company typically is audited once a year, and the audit it's fine to get the audit done by June. And as soon as you transition to public, you're now subject to the SEC schedule of reporting, which is quarterly reports that have to come out either 45 days after the end of the quarter, or in the case of the annual, have to be announced, but 90 days after the end of the year. And that changes the dynamic. The amount of resources needed internally, both in terms of people and systems and processes, really gets ratcheted up. And what I always focus on first is building out the team. I find that, to your comment, Sarah, about the underestimation, often you look at the finance and supporting G&A team, and it's very fine to run them on a shoestring as a private company. But if you're going to make the commitment to go public, you really have to build that out robustly. CEOs often look at that as G&A expense and want to limit that and want to keep most of the spending, towards R&D, which is what's creating, the true value. But if you're going to make the decision to go public, you really have to invest in that. And my sort of minimum crew, if I look at it, is I like to have, in addition to the CFO, I like to have a controller. I don't find you need a VP finance right off the bat, or although you could use a VP finance instead of a controller. You're going to need an SEC reporting specialist, someone who knows how to get the reports done on time and get them in the formats that you need to file. You're going to need a senior staff accountant, and you're going to need some other support staff there. And one of the big things, and Steve, you can comment on this related to Sarbanes-Oxley, is separation of duty is really important to have a lot of checks and balances to pass audits. So you're going to need people just to separate those duties in that process. I personally find you need a really good FP&A person, both to get through the IPO process and maintain projections, as well as to help with quarterly closes and making sure budget versus actuals are on time and you're communicating out to your public investors. You're going to have a communications person, IR, PR. Hopefully they've got a good background in the life sciences area, and they can understand and translate a lot of the technical issues into communications that are more broadly digestible by a greater public. And then the final thing I'll say is that even though this isn't in the finance department, you really need a good general counsel. And I really think you need one at least 6 months, if not a year, prior to going public. I know as a Section 16 officer who signs off on the S1 and then 10Qs, 10Ks, proxy statements, it's impossible for me to feel comfortable with everything that's in those documents unless I have a really good partner lawyer who I can trust that is also sort of making sure everything I sign off on is good.
A couple just points on that, Greg, and I don't know, maybe we have a little bit different experience. I have a number of clients that outsource a few of the things that Greg mentioned, including financial reporting and the preparation for going public. There are a lot of consultants, and the accounting firms can do this for you as well, as long as they're not your auditing firm, to provide external financial reporting advice. And I have found that to be critical. Well, if you don't have it internally, to have a good outside financial reporting consultant to make the process, to really facilitate the S1 process and the IPO. But then, in addition, on the general counsel point, I think a lot of my clients would consider me their outside general counsel, and there are a lot of lawyers like me that have a public securities practice that can serve that role until you find the right fit, and particularly for smaller biotech companies. And IR also. So a lot of biotech companies I don't find hire internal IR, PR people until the company has more regular news flow. So there are a lot of great consultants in that area as well.
And one thing I would add is, when you were talking about internal support system, is like Greg mentioned, right? I'm talking from the audit perspective, having a good controller, SEC reporting person, is when you actually do come to do the audits, right? It's gets very messy if the company hasn't been focused on the financials in accordance with GAAP. Some of the companies decide to go down that fast track of doing an IPO. We come to do an audit and it just gets delayed because of the internal financials have not been no one's been focused on that. And so that's one area that I would say just sort of focusing on and getting the right people at the right time. So,
I think preparing the financial statements is key. I mean, I really think like that, if I were to look back over the dozen or so IPOs I've done in recent years, that's the biggest issue for companies getting ready and ramping up and meeting their timelines, is making sure they have the financial statements in order.
And that's what, like you said, that's one of the reasons that can cause a delay in a filing, is because the financials are not ready to be audited. So
certainly.
And then, we've talked about sort of the internal support system. We touched a little bit on the external support system. We're talking about attorneys, we're talking about bankers, independent auditors. Karen, maybe you can just walk us through from a legal perspective, focusing on corporate finance, stock listing process, definitely a part of the advising team. Any of sort of speaking about the initial priorities from a legal perspective that companies should focus on early on in their journey?
Yeah, and I will say also, like, we kind of throw bankers in this outside advisor bucket of things that a company needs, but I would say you absolutely critically need to have bankers. Your IPO is not going to happen without them, and that's the first outside advisor group that I think the company starts interacting with to find out if there's an appetite, if the IPO is feasible, if you have bankers that are going to take your company public for you. And that discussion those discussions often start happening even years before an IPO, discussing with the underwriting investment banks your company story, getting them familiar with it, that sort of thing. And then really relying on those people to sort of guide the company on when the company is ready. The other people that you certainly can't go, outside advisors that you certainly cannot go public without, are external securities lawyers, a law firm like Wilson Sonsini or our competitor firms, and independent audit firm. So you just can't, you just absolutely cannot go public without those external advisors. And on the finance side, the audit firm is really good, and your financial reporting person, whether internal or external, are really going to play a critical role, like we just discussed. But also your external securities lawyers end up being the people that pull the whole thing together, really. So there's almost an infinite amount of regulation regarding offering your securities to the public. And so the securities lawyers end up running that process really and pulling the whole thing together. And then sort of, and in close contact and working with the management team, and then sort of hand it back to the bankers to sell the deal. With respect to the other key pieces, we've talked a lot about financial statements, and I just want to reiterate that's really a critical part of preparation for the IPO and the S1 itself. The other couple critical parts, there are a few that also relate to financial information management, the MD&A section and the CD&A section. So there's a lot of information that the lawyers need from the company related to the financials of the company and executive compensation. And the collection of that data falls on the finance department, and then the lawyers sort of pull together the disclosure in many cases. And then there's a part of the S1 we call it the business section, colloquially. It's the business summary. And that's the marketing piece of the document. It tells your company's story. It talks about the background of your company, the research that you're doing, the data you've collected, the clinical trial plans for if you're a therapeutics company. It talks about your sales and marketing, your manufacturing, all of that. That is a pretty big lift. And once I think before the company's decided that it's going to go public, no reason to really focus on that. But once you've decided that you're going to go public and you have your finance team working on getting the financial house in order, the management team needs to start thinking about telling the story of the business. In biotech, these business sections are frequently 25 to 40 pages long. The lawyers come in once it's started and help make it SEC compliant, but that's a pretty big effort. And there are external consultants and storytellers that can help the company with this, but for the most part, it really falls on management and your external securities lawyers.
And then going back to Karen had mentioned about financial statements, they need to be done under PCAOB regulations. I know startup companies, you're getting a private company audit done, but that needs to be upgraded. If you have been doing audits before, but if and they need to be upgraded up to PCAOB level, a little bit more of an uplift. And so also the number of years in the S1 also depend on whether you've had transactions, any M&As, anything else going on. But so sometimes it's better to start that sooner rather than later. So towards the end, you're not scrambling and dealing with all these external advisors, and everybody needs your time. So Greg, maybe anything you want to add on your experience as a CFO building a support team?
Yeah, well, I think Karen laid out pretty well the external advisors, and I think, as she pointed out, my view is that you need all those external advisors, but they're not in place of internal people if you really want to end up with a successful company, not just in the IPO, but then after it. You need to be able to have the experience looking back. Like, I usually get to drafting the S1 internally, and you can work with a consultant, but it's really hard to explain, some of the details of the science and the business. The only other external advisors I might add is, depending on if you have revenue, and this includes any licensing deals you might have done, having a technical accounting advisor, revenue recognition is like super hard. It is not at all apparent as a CFO. You're like, oh, well, I did this deal and this is how I would account for it. And the memos never agree with that. And you end up spending a huge amount of time on that, even though a lot of it's non-cash comp and everything else, and you've got to create 30-year amortization schedules and everything else. But there's good technical accounting advisory firms out there. Another point I would just make is when you are looking to assemble your external advisors, you don't want to be the first, second, or third company that they've gone through this with ever. You don't want to pay them to learn on your behalf. And in addition, it can really help the process. Like one example I've had is, one of the advisors that is going to be involved in the IPO process is going to be underwriters counsel. Underwriters hire them to protect their legal interests, not yours. But you have to get agreement between underwriters counsel and companies counsel to get through the process. And you go literally word through this very long S1 document and make sure that any claims you're making are accurate. We had one, and I won't name the company, where we were going through the process and we kept claiming that, based on p-values, the data was statistically significant. And underwriters counsel literally had no idea what a p-value was. And it didn't become apparent until we'd spent 2 hours arguing over statistical significance. So you got to make sure that your accountants and your lawyers really understand these issues and can help through this process.
And as the company, once you've selected your underwriters, you can influence who the underwriters hire as outside counsel as well, to make sure, to Greg's point, to make sure that it's a set of securities lawyers who do this, who do life sciences and who do IPOs. Yeah.
Steve, I don't want to leave you out, but generally internal controls are not always top of mind for startup companies. Mm-hmm. What would you suggest companies do that intend to pursue an IPO from an internal control perspective?
Yeah, Greg hit it on the head earlier when he talked about the importance of dealing with people, process, and systems. And so it really, as we talked about personnel in particular, really having a strong controller / VP of finance who's been through this process before is of utmost importance. You've heard the expression, you can't fight City Hall. Well, you can't fight the PCAOB either. There's a lot of comments that come out as a result of that, and having someone who's willing to work with the external auditor and the consultant and management as sort of a three-legged stool to get to a successful place is really important. So either having someone who's been through the process before, or someone who has the mindset, to flow like water when you're getting some difficult comments back from the auditor about what one might consider minutia or elements that just go into a lot of detail that they're not used to in a compliance-rich environment. So very important, I would say, to hire a competent controller, et cetera. But you get into the elements of financial readiness, and internal control over financial reporting, that transition from going from an entrepreneurial mindset of developing a company and building it with a core team to being part of a compliance-heavy environment, again, is a pretty heavy lift. And so the biggest element that it can either be a benefit to you or an enemy is time. If you are going to be a large accelerated filer post your IPO, you have a much shorter runway to meet your compliance requirements, and it is a very heavy lift. The compliance pendulum continues to swing in more of the direction of greater scrutiny over the transparency and the accuracy of financial statements. So the earlier you can get started on this process of getting that house in order, of making sure that you have the right people and that you're developing the right processes, is paramount. And so again, leveraging that element of time is going to be the most important element, especially when working with a particularly competent individual.
If I could add just onto what Steve is saying, depending on the size of your company and your market cap and different things, it depends on whether you need to comply with SOX in a formal attestation, but you really need to be able to say you can comply with it well before you attest that. To me, one of the big parts of that is systems. I have taken companies public that are still on a QuickBooks accounting system, and Moss Adams has been the auditor, and it works, but it is painful in terms of meeting those timing deadlines. So you really should start thinking about transitioning to systems which are very auditable. SOX is all about audit trails from my perspective. I don't know, Steve, if you think the same thing, but so if you have an ERP system, like a NetSuite, and then other modules that plug into that ERP system that are easily auditable within the systems. It helps a lot. You got to have your internal people who know how to do it. You clearly hire consultants both to help you set up the ERP system and to do your SOX testing and other things like that. But that is a big and expensive part of going public. I mean, just between getting yourself ready for SOX compliance, getting an ERP system in place, you're talking at least $500,000 up front.
And then, Steve, one of the pitfalls we've all seen with life science companies has been a material weakness in establishing those internal controls. Generally, life science companies traditionally have lower headcounts, shorter IPO runways, and so they're likely to need attention in this area. Can you speak to some of the pain points that you've seen companies needed to address in this area?
Absolutely. So Greg touched on one of them, which was the technology element of it. As the PCAOB comments continue to flow in, I think one of the biggest comments that comes from the transparency and the completeness of key reports. And in order to address those elements, it's a very tough bar to meet the compliance requirements on QuickBooks. I think several years ago, we did have several clients who were able to go public and were able to leverage QuickBooks with external controls or internal controls outside of the system to make it sort of work. I think those days are past us. I haven't seen a company go public with QuickBooks without a material weakness in the last couple of years. So the challenge with QuickBooks is just, again, to Greg's point on the audit trail, the ability to systematically enforce segregation of duties, overriding journal entries. These are all challenges that you have with QuickBooks. Change management in IT also becomes a big factor depending on the system that you have. I would say the vast majority of the clients that we see in the life science space have been moving to something like a NetSuite or a Microsoft Dynamics or a 365 type scenario where all those elements are covered. But we mentioned, again, people, process, and systems. So systems is one element of it. I want to touch back again on people because, again, the biggest challenge is usually headcount. Again, what we find with life science companies is the overall headcount is lower. And so it becomes a challenge to find a segregation of duties with competent, and I use the term competent just in terms of education and background to do the work that's needed. Another area that in terms of process is little things that you wouldn't think about. Journal entries, reconciliations, them being independently prepared and reviewed. The reports that are leveraged to create that have been validated for completeness and accuracy. So again, people, process, systems, there's something in there for everyone as far as an opportunity for a material weakness. And so one of the things that I find astonishing, and we're doing a program on an SEC comment letter element, a little shameless plug there, but the one of the things that I noticed in that we talk about is Audit Analytics, a reporting company, indicates that almost 40% of all S1s have a material weakness in them. That's an astonishingly high number. And when you think that if a lot of them are 404A, a lot of that might be self-reported as well. So definitely a challenge when you talk about challenges to ICFR. It becomes, again, that not only the headcount in terms of the volume of heads, but the competence and the ability of them. And that's where Greg had talked about building out the team with additional elements of financial reporting, the controller, the VP of finance, et cetera, having a strong team there. So again, people, process, systems, segregation of duties is top of mind. Headcount is top of mind. IT systems is top of mind. And then that element of that blocking and tackling and accounting of independently reviewed and approved journal entries and recons tends to be a big area as far as that's concerned. One more thing I will note as far as material weaknesses go is, it's not the end of the world to have material weakness. And again, with that 40% number, you still have the advantages of access to capital, the prestige that comes with going public and other elements, and you get that access to other elements as far as having that cash flow. Again, if you haven't upgraded to an IT system, that would be a good time to do it. But again, that's the main part of what we see when we see a material weakness. 40% of companies, which again is an astonishing number.
Yeah, I just want to add on to that, which is it isn't it is I have not found it to be a barrier to going public to have material weaknesses. In fact, as a CFO that's signing these statements, I don't mind there being a material weakness if one actually exists. I almost never have gotten that question from investors either on the roadshow or afterwards. And it's better to have a material weakness and remediate it than to go public without a material weakness and then for one to show up. So it's a little bit technical. I'm sure the CFOs in this call completely understand it, CEOs and board members. It's not like you can't go public with one. It's just that over time, you do want to make sure you address them. And regardless of actually the specific designation of material weakness, you just want to feel comfortable that your company is reporting things properly and without fraud. So just to echo Steve's comments, sir.
I agree with that. The lawyers don't have any concerns about taking a company public with an identified material weakness or significant deficiency or going concern in the life sciences space, and the Underwriters Council won't be worried about it either.
Okay. I know we have a question on board members. So generally analyzing corporate governance and board member roles prior to an IPO can strengthen the company's leadership and identify any changes necessary to satisfy exchange listings and SEC requirements. Greg and Karen, can you comment on best practice for corporate governance, including board meetings, audit committee meetings, earnings calls, just anything that you've had from your experience with dealing with corporate governance?
Yeah, there's a whole nother side. So there's the sort of operational side of an IPO that we've been talking about, which is getting the disclosure ready for the S1 and getting the deal closed. But behind the scenes, there also is a lot of corporate governance related matters that your securities counsel will be advising you on, that to sort of help the company grow up to be a public company. And I'm not trying to say that in any sort of derogatory way, but board governance, corporate governance in a public company is sort of a really next level of corporate governance that a private company has to worry about. And there's a number of reasons for that. But the biggest reason for that is, and SEC and NASDAQ or New York Stock Exchange oversight is one reason why compliance is essential. But probably the biggest reason is because you're going to have public stockholders. And once the public owns your stock, the litigation risk is much higher. The amount of scrutiny that your company will receive from the public is obviously much higher. When you're a private company, you know all your shareholders. When you're a public company, you don't know most of them. And so there are a number of things that come along with that. On the compliance side, this addresses, I think, one of the specific question in the chat with respect to board governance. Your board of directors needs to transform into what's called independent, an independent board. And on a very basic level, that means that the majority of the board doesn't have conflicts of interest with the company, including by way of employment. It doesn't, although frequently, trickle down into your venture fund representative serving on the board. That is generally okay. You'd have to talk to your securities counsel. But with respect to founders and management and folks like that are compensated by the company, for the most part, all but one, maybe two of those people will be rolling off the board. The SEC and the exchanges require a majority of the board be independent. You are going to have independent members of the board staffing the committees, and the committees have to be an audit committee and a compensation committee, and not required, but for NASDAQ, but most often a nominating and governance committee. There are phase-in rules where you can go public without those committees being all independent. You can even go public without a majority of your board being independent. The phase-in rules then under the exchange rules require you to phase into an independent board and committees in 90 days and then in a year. But I think in practicality, we see very few companies go public relying on the phase-in rules. Despite what in opposite to what we just said about material weakness, there really is a preference that the company is completely compliant with the board independence at time of going public. And the underwriters that are going to be selling the deal for your company are going to care about this more than they care about a lot of things. And so every so often we'll see a life sciences company go public without all of the committee members being independent. But for the most part, you really need the overriding practice is that you comply with the listing requirements when you go public. And then in addition to, and so that's on the management team and the board to sort of sort that out and recruit new board members and recruit people to serve on the committees of the board and to sort of shuffle off non-independent board members before you go public. But there's a whole host of other things that get solidified right around the time that the company makes a firm decision to go public, and particularly before you file your S1, your draft S1 publicly. And that relates to a bunch of policies. So you have a number of policies around compliance, disclosure, whistleblower, and policies, formal charters for all of the board committees that lay out responsibilities, related persons, transactions, policies, a number of things that have to be disclosed as being in place once you're a public company. And so your corporate securities lawyers and management and the board will be working to get all of that set up in advance of going public.
Yes, so I would add, just from my perspective, I see a question here as independence interpreted as allowing, yes, they can be paid for board service and fees and equity and still be independent. From my perspective, my greatest interaction is always the chair of the audit committee. Again, I would go back to an earlier statement and say my extremely strong preference is to have somebody who this is not the first time they're chair of an audit committee. There's a lot of people that transition out of either from the corporate side or the accounting side that qualify to be chairs of audit committee, but the cadence is that you go to at least quarterly audit committee meetings. Really, the audit committee chair should be running that meeting, not the CFO. And they should have a set of requirements that they require to be addressed on a quarterly basis. And those are obviously all around reporting, but they go into other things. It depends. Sometimes the audit committee is also the risk committee that oversees, IT risk and other things like that. So my preference is someone that's been there, done that. And I like to work with both them and in-house counsel to make sure that there's sort of a very repeatable section of the audit committee meeting so that it's almost template driven. There'll always be things that are added, but so that you have a good cadence of checking in on things and continuing to assert that things are in order. Personally, when I work with the audit committee, I really like to feature my greater finance staff, because I think it's good when the audit committee members know, and especially addressing some of Steve's issues about, they should have an idea of where the weaknesses are, where the compliance needs to improve, and be able to make their own independent assessment of that. Because a lot of that stuff really falls on the board, not just on the management team.
And one thing on that, Greg, I agree with you. And if you don't have an audit chair, or if you don't have committee chairs in general that have done this a lot or sort of have their own set cadence, you can ask your outside counsel for like calendars for these committees so that you don't forget, so the committees don't forget to do the things that they need to do on a regular and annual basis, because a lot of that ends up being disclosed publicly as well. So there's kind of like a typical cadence for this stuff, for the governance stuff at a company. And then real quick on the point about compensation, that reminded me. So Greg answered the question already, but board members can be paid for their service and still be independent. They can be paid for their board and committee service specifically, but not for other things. And that is something that in preparation for an IPO that you'll need to get your arms around as well. So public boards are paid, always paid, cash and equity. And typically as part of going public, the company sort of relooks its compensation practices in general. It's board compensation practice, and you put in place a policy for that. And then also very often executive compensation is revisited ahead of going public, including perhaps new employment agreements that contain terms that are typical for public company executives, such as severance. For example, a lot of private companies don't have robust severance agreements in place with their executives. And that's an additional potential external advisor that we didn't mention earlier. There are compensation consultants that advise on public company compensation because of the extensive disclosure that's required around it. And if not that extensive right when you go public, because maybe you're an emerging company or a smaller reporting company, but as the company grows up, the disclosure around compensation is extensive. And so most companies, as they grow up, hire a compensation consultant to give them advice and market data on those points.
Great, thank you. One sort of other area I feel that takes quite a while is sort of preparing for the due diligence. During an IPO, underwriters and their attorneys will likely perform extensive due diligence reviews on your company, including a thorough review of financial information, the history of financings, legal documents, all the board minutes, capitalization records. So, I would make sure that you start making sure that those are in track sooner rather than later. Greg, maybe you can sort of help explain, as you begin working with third parties, what are the best practices for centralizing this information for due diligence, and what kind of timelines have you seen?
Yeah, so again, this is, 6 months to a year ahead of time. I like to start drafting the S1, with internal resources, and then bring in the consultants as we get closer. You're gonna get, as I made before, any statement you make in the S1 is going to be challenged by corporate counsel, the underwriters. Just briefly, going public is the underwriters are not selling your stock for you to investors. They're actually buying it from you for a nanosecond and then selling it themselves to investors. So they bear the full responsibility of any misstatements in the S1 itself, because that's a document that plaintiffs' lawyers will look to when they make their claims against the underwriters in the company. So that's why there's this heavy emphasis on any claim you make being properly supported and properly caveated. So once you sort of have your own first draft, then you can pass it by your external corporate counsel, and they can look at it and say, well, this is going to be challenging, that's going to be challenging, you need the backup here, you need that. There are lots of consultants and data services that you can subscribe to help you find and substantiate all of those numbers. The key to getting through that S1 process is getting the good mix of making strong enough claims so that people are interested in your story, but with enough caveats and backups so that when things happen, as they always do in the life science industry, you've sort of got that disclosure defense. In terms of mechanistically, we always use a data room solution. The printing companies, which, a lot of the stuff is done electronically now, they all offer services. They seem to work well. You can try to do it on Box and things like that, and it isn't a bad way to get started on something like that, but most likely you're going to have to port it to a data room structure that is specifically set up so people can, share documents easily with the proper controls and make comments back and forth and so forth. It's not that expensive even to set up. As a private company, you're talking in the tens of thousands of dollars to get something like that set up a year. And the earlier you start assembling your backup, the better you'll be. The last minute scramble in the IPO process is usually some element around this of disclosure, in your S1 at the same time as you're trying to get your roadshow story right and get investors interested. And so the less of a last minute drill this is, the better off for you.
And, and talking about preparedness, if your company's never been audited, the first year audit always takes the longest because we are looking at history, we're looking at equity financings from day one. And so just having this data room or information gathering process where from an audit perspective as well will definitely help down the road. First year audit can take maybe double the time of a second year audit because of all that extra work we need to do to get comfortable with what's been happening.
Don't think at the last minute oh, sorry. I would just want to say, don't think at the last minute you're just going to be able to say, oh, we're going to hire an auditor. I mean, the supply and demand of auditing services is not moving in companies' favor. There's fewer and fewer public auditing firms who are providing the services. They're losing employees to companies. It's not easy. So when you pick that auditor in the beginning, make sure that auditor is going to be able to stay with you through this process. Like I don't like hiring an auditor that says, oh, they're less expensive, the private company will make a switch at the time, because there's no given. And if you're in a hot IPO market or even a moderate one, it's not easy to do. So the earlier you get working with your auditors, the better. And you also don't need in your mind that you have to work with a Big Four. There's great auditing firms all the way from Big Fours all the way through the process. And to give Moss Adams a plug, I've worked with them on a number of this, and it works great. So, but that is definitely something you can't leave to the last minute.
And I would say there's lots of things that go into just doing an audit, right? One thing I do want to touch upon is stock valuations, for example. Companies should be regularly getting a 409A for their own tax purposes anyway, but especially for stock valuations. And what I've seen is that the SEC have been looking at valuations at least 12 to 18 months prior to filing. And so just having that story around your valuations is very important. And that will, those are some of the areas that sometimes take time when we're finalizing our audit, is waiting on those valuations. And we use our internal valuation specialists to review those to make sure the assumptions, methodologies, and sometimes that does take time in making sure we're all on the same page. Greg, Karen, anything you want to add on valuations of stock?
It kind of goes in and out of fashion at the SEC how much they care about it. In the last IPO boom, they decided to care about it again a lot, whereas like in the teen years, they didn't care about it a ton. And so it's always a little bit of an unknown about how much the SEC is going to care about it. But you should be talking to your lawyers as you're ramping up for an IPO about the valuation method that you're using, what the inputs to that are, because ultimately what will happen is your lawyers, in connection with your external auditors, will be working on a letter to the SEC at the very last minute to justify the pricing of options in up to 2 years before the IPO. And so we have a lot of experience with what the SEC is looking for and expecting, and can help guide that process, that valuation process, is really as soon as the company decides it's going to set down on the path of an IPO in particular.
Yeah, so I like to, the earlier stage, the company, you tend to just do your valuations either after a financing event or a partnering event, or annually, just so that you're up to speed. I find that you can address this issue by, if you've got a new 409A once a quarter in the year before you go public, you can usually close the gap closer to what the IPO valuation is at the time. In the beginning, you're trying to have low 409 valuations because it's a big attraction and retention tool for employees. As you're moving closer to the IPO, you can still have a discount to the public market valuation, but that gap's got to close very substantially. And if you use sort of the same 409A provider, for a year or two ahead of time, and you step it up on a quarterly basis, usually I haven't had a problem with those memos, but you've just got to show that trail that that's what you did.
There's a question in the chat about does a quality of earnings or fair market opinion ever feature in IPO transition? I haven't seen that, but just wanted to see from your point of view if you've seen
the
that.
only thing I would say there is it hasn't been around quality of earnings. Fair market value comes in a lot into accounting. And again, that's actually one of the key things that a technical accounting firm will do, is trying to figure out how to value a complex transaction. So let's say you do a licensing deal with Big Pharma and they pay you X amount of money up front and more money is due on milestones in the future. You have to fair market value the different elements of that. And doing that internally is next to impossible, I find. And if you have a good technical accounting person outside of that, they can actually write an opinion and a paper that goes along with it. And that will satisfy SEC requirements, often in conjunction with your own audit firm. And that's the only place I see it come into. The investors themselves aren't going to question what did you use for your methodology. You just have to get your overall financial statements approved, and this can be an element of it.
And just to add, from a PCAOB perspective and independence, your auditing firm cannot also prepare your technical accounting. So like Greg mentioned, we're using a third party, and we at Moss Adams can be that third party if we're not the auditors. So for example, we've done a number of IPOs where we support the IPO process, where another accounting firm are the auditors. One other thing I sort of wanted to touch upon is just public communications, investor relations, and sort of putting a plan on communicating internally and externally about about the company going public. And I know there's SEC restrictions on that communication. Can either you, Karen, or Greg, talk about some of those restrictions?
Yeah, so in today's IPO market, for the most part, companies are well underway of going public before the public ever knows about it. And that's because of the SEC rules that allow companies to file their S-1 and get through the SEC comment process on a confidential basis. Most often, and by the way, that you're not allowed to talk publicly about your IPO. So there's a very limited ability to, once you file your S-1 publicly, to put out a press release saying that the company filed its S-1 publicly. That's literally all you're allowed to say. And most companies don't bother saying that anymore because the news cycle is such that that word gets out without the company having to publicize that itself. So most companies don't talk publicly about the IPO at all. You actually can get in really big trouble as a company if you talk to the IPO and about the IPO publicly or make statements about plans to go public. It's called gun jumping, and your whole IPO could fall apart. So for the most part, companies stay quiet about it. The exception to that is what's called testing the water. So once you file your S-1 confidentially the first time, and the reason why it doesn't happen before then is because that means that you've gotten through the diligence process with the Underwriters Council. Your auditors have signed off on the financial statements, and you've actually taken an affirmative step to go public, albeit the public itself doesn't know that yet. Your underwriters, the investment banks that are going to help place the deal, will start introducing you to potential investors in one-on-one meetings that are confidential and that talk about your company. Those are, we call them testing the waters, because the idea is that you're sort of testing the waters with potential investors to see if there's a deal to be had. Those meetings are, again, they're confidential. You don't give them the S-1. You don't talk to those investors about the offering terms, like how much stock you're going to sell or at what price. It's really just about your business. And they are facilitated only by the underwriters that are running your deal for you. So again, it's still not publicity. In fact, it's very sort of done very quietly in one-on-one meetings. And also while you're doing that, and so you're doing that, and then the underwriters will then call back the investors and get their input on the business and their propensity to invest in the deal if it ever happens. but most companies then completely go quiet, and they go quiet in a public way because of the potentially disastrous results of being accused of publicly talking about your IPO. So most companies come off the circuit and they stop going to investor conferences. They stop participating in publications that are non-scientific, that sort of thing, because if any of those things could be deemed to be publicizing the public offering, the deal could fall apart or get put on hold, unfortunately. And I know, Greg, you probably have feelings about this as well.
Yeah, what I would say, and the way I think about it is, you're going to need to hire an IR firm after you're public. It's really hard to manage it on your own. A lot of them will try to sell you their services pre-going public. I'm not a fan of that based on what Karen just described. The underwriters are really going to have the heavy influence in helping you shape the story, and they're going to know what and when things can be said and cannot be said.
Yeah, and their counsel is very involved as well. But I don't know, Greg, I know the testing the waters is a whole, right? It's a lot of work for management. So,
yeah, it's just part of the process. You're going to do it. And you're definitely going to do it in the life sciences area because the stories are complicated and the underwriters use it as a final confirmation that they think there's going to be enough demand to actually expose you to going public. And that is a process that I haven't seen it done without that recently.
So as we're sort of towards the end, just any last minute comments on pain points that you've seen when you've seen companies go public? One of the comments I would like to say is, when the companies sort of like Greg, you mentioned, right, last minute needs to get an audit done. At the same time, the company is trying to do due diligence, trying to talk to the underwriters, trying to put their S1 together, right? Everything just gets delayed. So I definitely would make sure that you are prepared for an IPO, even if it's just a discussion, at least preparing internally, externally, getting your audits done, talking to your law firm about things that you need to put together. Anything else that the three of you can add to how companies can be the best prepared?
Yeah, I'll jump in. So in my mind, IPOs are definitely not for everybody, but they are, as I think Steve mentioned, they're the best way to access the lowest cost capital and the greatest amounts of capital. And life science companies need capital, and you're going to operate at a deficit usually well after you go public. And the best way to get that money to advance your programs through clinical trials and commercialization is to go to the public. And the public is well-versed and used to financing life science companies this way. The caveat and the as we've said today is, if you're going to commit, you have to commit. So you're going to have to spend $1 million to $2 million prior to you knowing that you have a public deal that gets done, in both upgrading your staff, your processes, your documentation, relying on outside consultants, et cetera. So just, go into it eyes wide open. There's no such thing as doing an IPO on the cheap. It won't work. I've seen people try it before. But if you do get through the other end, it's great. It's great in terms of your ability to raise capital. It's great in terms of attracting new investors. It's great for your employees. It's nothing to shy away from. There's a lot of stuff we talked about today, but this happens, hopefully 100 times a year. So there's a good ecosystem out there to support you.
The other thing that we haven't talked about getting ready, particularly from a financial perspective, is D&O insurance. So you can't just call your D&O insurance carrier the day before you go public and be like, hey, look, we need to upgrade to a public policy. They have a diligence process themselves, and they have to get underwriters involved for the D&O policy as well. So involve those people earlier rather than later, for sure, when you have an S1 together. So you need to give your S1 to your broker to get upgraded D&O insurance, and the sticker price is going to be shocking. So build that into your budget.
Yeah, and I would add that the biggest friend or enemy that you have is time. in terms of if you have a sufficient runway, you can ramp up in a reasonable way while people still are performing their day jobs, and it becomes much easier of a lift. If you know, for instance, that you're going to be a 404B company once you go public, and you have to ramp up with very steeply with your compliance requirements, it's a task. It's an arduous task, and so or onerous task. So again, focusing on time if you've got it. One of the advantages of the current market is that you can be ramping up before the IPO happens to really set yourself up for success. So that's what I would. And the other element is really establishing a culture of compliance. That's a tough gig. Again, as we talked about, when you move from more of an entrepreneurial mindset into this compliance-driven environment, that willingness and that desire to be compliant across the board, if you have that mindset, you'll be successful.
Thank you for your insights today.
Thank you.
All right.
Thank you all for attending, and you can reach out to any of us if you are fortunate enough to go through this IPO journey.